The bull market has been on the run for over 6 years. So how does an investor who bets on market crashes ever make any money? Let's ask Mark Spitznagel. He's the chief investment officer of Universa Investments, which manages $6 billion. He is also the author of The Tao of Capital. His firm thrives off corrections. Well, we haven't gotten too many since the financial crisis. Raising money for black swan funds, tail risk funds was all the rage. But when we don't have corrections, when we don't have big moves, what happens?
Right. So what you refer to here is something of a marketing gimmick. You know, certainly not the way we do it, but this sort of rise of tail hedge funds since the crash. Of course, we're always looking at what happened in the rearview mirror. So this is sort of a marketing gimmick that happened.
How do you do it?
Right. So the way to think about my business, my strategy, what I do for clients is really allow them to be responsibly long. So, you know, perhaps there's something of an irony here. How can, you know, perhaps I'm the most bearish investor, the most bearish investment manager you'll find today. So
Hang on a second. Today or anytime?
It depends on what's going on in the world. But certainly,
but on any given day, you might be the most bearish man in the world.
That's probably a fair statement.
Really?
Maybe there's someone, investment manager. Maybe there's someone hiding in the basement who's more bearish than I. but so there's an irony here. Perhaps how could I be used to make someone,
good question,
my clients longer? So the way to think about this is, it's really the asymmetry of my returns. You know, when markets crash, I make up the tail hedge makes up a very significant portion of the portfolio. Very significant. It adds significantly to the portfolio. When there's no crash, it's a very insignificant part of the portfolio.
In other words, it's insurance that doesn't cost them that much money?
That's a good way to think about it. So it's the extreme asymmetry of the returns that matters. The asymmetry, what
so
returns.
So hang on a second. I get that. I know Stephanie gets that. I hope everybody else gets that idea. But again, since the financial crisis,
you were founded in 2007.
But since the financial crisis, and we saw those asymmetrical trades pay off so handsomely for people who were positioned properly in credit default swaps, aren't those asymmetrical opportunities harder to find? Are they not more expensive than they used to be?
Well, they're easier to find today, and this is part of the beautiful thing about the business is, you know, when the markets get really rich, really overvalued, really distorted like today, the cost of insurance goes way down. There's incredible complacency.
No vol?
Yeah, our pricing for
there's no one taking the other side of the trade. There's no volatility.
Well, to the contrary, there's people. Well, even more so, I should say, that people are selling. So this is another one of those carry trades that are so popular today.
And they're selling why? Because defaults are so low?
Well, sure. We're back to this sort of great moderation. I mean, there's a full belief, a religious belief that the Fed is our savior. And it's priced into the market.
And what has your performance been like? So if you were founded in 2007, we obviously hit a bad time in 08, and then we've been on a great run since then.
Well, you know, these are private partnerships. I really can't talk about that. But the key to all this is, again, I allow my clients to be longer. And while they're longer, they actually make money in a crash, but they are able to be longer because of this. So it allows them to be really agnostic about it. It allows me to be agnostic about the direction in the market.
That's a key point, though. This in and of itself isn't an investment strategy for most people, right? Because you're going to make big money once every, 7 years. But you're not going to make a lot of money in between. And so if you are an investor who needs income, right, like an endowment, for example, or a pension fund, right, to match your liabilities, you can't really invest like that, can you?
Well, that's absolutely right. But the thing is that it's a tiny piece of the portfolio. You invest also in a larger piece for stock.
But I couldn't take all. It would be wise to take all my eggs and put them in your basket.
Oh, you wouldn't want to do that. That wouldn't make any sense. Yeah.
Now, you use Tobin's Q ratio to kind of explain your investing. What exactly does that mean? Let's get nerdy.
All right. Well, without getting too nerdy or in the weeds.
Oh, we like to get nerdy in here. You're in the house of Bloomberg.
Right. So the best way to think about it is sort of an aggregate price-to-book ratio in U.S. corporate world. The numerator, all right, we're getting nerdy. The numerator.
Wow, you didn't think that was too nerdy? Wow, really?
Yeah.
That's nerdy.
Right. The numerator is total corporate equity. The denominator is sort of replacement value of the tangible capital. So, you know, you can follow this over the last 100 years, and you can see that we're at an extreme point today. We're as extreme as we've been in the last 100 years, except for 2000. So you can read that into read into what you want.
Hang on. The most extreme we've been in the last 2,000 years.
No,
save,
100 years.
100 years, save for
2000, which was probably, it's certainly that was one of the great bubbles in human history. So here we are today,
the
just
second
shy
largest
of,
bubble in 100 years.
Oh, I'm not. Yeah.
Yes, you think this is the second largest bubble we have seen in history. And do you attribute this market distortion to Fed actions?
Oh, absolutely. So one thing that this ratio does is you can think about the numerator as this realm of the stocks, which are stocks are the sideshow of the world. They really shouldn't matter that much. They matter too much. They're the realm of punters, the realm of hair trigger traders, flashing colorful lights, blips and bleeps of Bloomberg terminals.
So macro is where it's at?
But then the denominator of all this is what does matter. This is investment in capital, investment in the tools of higher productivity and of really the progress of civilization. And so we've seen the numerator go up so much and the denominator isn't going up. And what does that mean? Why, those two things should interact with each other. They should be tied to each other. Why? The reason they're not is because the Fed has driven this wedge in between them with these artificially low rates.
Mark, can you predict at all how long it's going to take before the market reverses course, before this bubble that you described ends up bursting?
Well, that would be impossible because it's entirely driven by the Fed, and we don't know what they're willing to do next. So if I know exactly what they're willing to do next, I could probably have a fairly good idea, but I don't know what lever they're going to pull next.
So if you were an investor, why wouldn't you do... No. Another kind of investor, what a guy like David Zervos, right, from Jefferies says is, if you're right and it's all up to the Fed, why not just do what they say until they stop saying it? In other words, if the ECB is buying, right, and trying to inflate the prices of risk assets, own those risk assets.
Right. So this is what the entire world is doing, what you're describing. Don't fight the Fed. Go with the Fed. But, of course, the problem there is we're relying on our ability to change our mind, change our position. Is there an exit to this idea for us? You're relying on liquidity, of course. And what we don't understand about markets, there's a buyer for every seller, there's a seller for every buyer. The market doesn't owe you. The market doesn't owe you. The market doesn't owe you liquidity.
Then how concerned are you about liquidity, and how illiquid are the markets today?
Well, they're extremely illiquid today. I mean, for so many reasons. One of which is there's less of a dealer community out there, thanks to regulatory changes. Giant liquidity holes are a part of market dynamics. It's always been that way. I grew up in the pits of Chicago. Liquidity holes happen all the time. You put your arms down when you don't know what's going on. You leave the pit when you don't know what's going on. This will happen today. It'll happen the next time down. So to think you're going to lean on these buy orders is the height of naivete.
Mark, we thank you very much. Mark Spitznagel. Next time you come, we're going to have to get nerdier than numerators and denominators in a long division.
We're not going to get that nerdy. I want you to watch this back. It's kind of nerdy.
All right, that was Mark
awesome.
Spitznagel of Universa.